$500 billion. That's how much value just evaporated from AI stocks in the last 48 hours. And here's what should terrify you. We might only be in the third inning of this sell-off. Today I'm going to show you exactly what's driving this bloodbath, which stocks are getting absolutely demolished, and most importantly, where the smart money is rotating while everyone else panics. Stay until the end because I'll reveal the one move that separates investors who survive corrections from those who get wiped out. Let's get into it. So why are AI stocks suddenly toxic? 3 words: reality versus expectations. For 18 months, Wall Street priced these companies like every single one of them would become the next trillion-dollar behemoth. NVIDIA trading at 40 times sales. Companies with zero profits valued like they'd cured cancer. The market was pricing in perfection, and perfection never arrives. Now the data is catching up. Morgan Stanley just released a report showing that enterprise AI adoption is running 40% below projections. 40%. Companies are realizing that buying NVIDIA chips is the easy part. Actually deploying AI at scale is brutally expensive and complicated. And here's the pattern interrupt you need to hear. This isn't 2022's rate hike sell-off. This is something different. This is a valuation reset happening in real time. The Magnificent Seven have shed over $1.2 trillion in market cap this quarter alone. But here's what the headlines aren't telling you. The damage isn't distributed equally. Let's talk about who's getting destroyed the hardest. NVIDIA is down 22% from its highs. AMD has been cut in half from its peak. Super Microcomputer, remember when that was the hottest stock on Earth? Down over 60%. The picks and shovels plays that everyone said were safe are getting absolutely gutted. But here's where it gets interesting. Look at the second derivative AI plays. The companies that were supposedly going to benefit from AI adoption, software companies, cloud providers, even some industrials that added AI to their investor presentations. They're getting sold even harder because the fundamental case was always thinner. I pulled the data this morning. Stocks with AI mentioned more than 10 times in their latest earnings call are down an average of 31% from their 52-week highs. Stocks that mentioned it less than 3 times, down only 12%. The market is literally punishing the hype. Now here's the part most finance channels won't tell you because it's not clickbait enough. The smart money started repositioning weeks ago. 13F filings show that institutional investors reduced AI exposure by $47 billion last quarter. $47 billion. While retail was buying the dip in January, Bridgewater, Millennium, and Point for the exits. So where's all this capital going? 3 places. First, and this might surprise you, utilities. Boring, dividend-paying utilities are seeing their largest inflows since 2020. Why? Because if AI actually does take off, it needs electricity, massive amounts of it. Data centers are already consuming 4% of US power, and that number is projected to triple. The smart money is playing AI through the back door. Second destination, healthcare. Specifically, large-cap pharma. These stocks trade at 12 to 14 times earnings, pay dividends, and have pricing power. When growth stocks implode, defensive quality becomes very attractive very fast. Third, short-term treasuries. The 6-month T-bill is paying over 5%. When you can get 5% risk-free while the market figures itself out, a lot of institutional money says, why wouldn't I? Now let me be direct with you. I'm not telling you to panic sell your AI positions. That's usually the worst thing you can do after a major drawdown. What I am telling you is this. You need to understand what kind of investor you are. If you bought NVIDIA at $140 because you have a 5-year thesis on AI infrastructure, this sell-off is noise. Painful noise, but noise. If you bought it at $140 because some guy on TikTok said it was going to $200 by summer, you need to seriously reconsider your position. Here's my framework. Ask yourself, if this stock dropped another 30% tomorrow, would I buy more? If the answer is yes, genuinely yes, not hopium yes, then you can hold. If the answer is no, or you're not sure, that's your signal. The whipsaw action we're seeing isn't random. It's the market processing new information in real time. And that information is simple. AI is real, but the timeline for profits is longer than the market priced in 12 months ago. Winners will still emerge from this space. They always do after bubbles deflate. Amazon out of the dot-com crash. Apple emerged from the 2008 crisis. But for every Amazon, there were 50 pets.coms that went to zero. Your job right now isn't to predict which AI company becomes the next Amazon. Your job is to survive long enough to find out. If this breakdown helped you understand what's actually happening in these markets, hit subscribe. I release deep dives like this every week. No hype, no doom posting, just data you can actually use. Click subscribe, hit the bell, and I'll see you in the next one.